How did you get on with this question? I mean, to me, there are three very, very distinct, separate parts to the question. So, it's possible that you're not necessarily going to watch the debrief of all three, because if you smash part A, what's the point in watching the debrief? You may as well, get on and start revising other matters. But look, I'm going to debrief the whole question. It's important that when you look at a question like this, you have a control copy paste as always. We're a construction company. Our year end is 30 June X3, and we've got three separate things. And when I look at the requirements, requirement A uses exhibit 1, requirement B uses exhibit 2, and requirement C uses exhibit 3. So we don't need to read the whole question before we can start answering it. And we have got a 12-mark question in respect of Weller. We are Weller, and this is about revenue, IFRS 15, a popular standard. And we've got to explain, we've got to explain words, how things are happening, and we've got to show the amounts which will be included in the financial statements. So it's very important that we understand that we are articulating and that we are being numerate in the sense of our question, answering the question here. We want to be marked out of 100. We want to be picking up all of our marks. So what are the key factors? What's the key sort of information that's going on here? Let's have a look. So we are Weller. We've signed a contract. We signed a contract, and we have begun construction work. We have begun construction work. And the date that we begin our construction work looks to be the 1st of January X3. Now, bear in mind, we're looking at a year end of 30 June X3. So 6 months ago, we started a contract, and there's no significant financing. Now, it's an 18-month contract. Okay. And we've got 8 million, 8 million, and 11 million that we're going to receive. So we've got a lot of money that we're going to receive. And those monies that we're going to receive are further payments because we've already received the deposit of 6 million. So if we're talking about revenue, that's how much effectively we're going to get. But there's a twist, because there's an element here of variable consideration. Because if we are late in fulfilling the contract, we're not going to get the last 11 million. We're going to get less money if we're late, if there's a delay. Now, in order to fulfill the contract, we buy some plant. So we've got some costs associated with buying some plant. We've got some costs associated with direct labour. And we've also got a problem with a one-off rectification cost. We've done something wrong. We've broken something. And so that's going to come into play. Overall, it's a profitable contract overall. But the contract is 30% complete. All right. So the contract is 30% complete by the reporting date. All right. So what we've now got to do is, we've read the question, we kind of understand it, and I think I want to make a start, and it's 12 marks. So I've got words, I've got numbers, and for me, in this particular scenario, it's the words that flow out first. We've got here a contract. And that contract is for the single performance of the construction of an asset. I'm not going to list out the 5 criteria, the 5 stages, the 5 steps of IFRS 15, but we clearly do have a contract here, and there clearly is only a single performance obligation, i.e. the building of the building. Now, when we recognise revenue the default is at a point in time. But there are circumstances when revenue is recognised over time. And this is one of them, yeah? As, you know, the asset is being built on land that Rainbow controls. So we're going to have to make a judgment as to how complete, yeah, when we've worked out the total revenue, but we're 30% complete, yeah. So it is judged that at the reporting date, the contract is 30% complete. So the next step is to work out the total contract price. Now, the maximum that you're going to get is, well, you've already got the initial 6. You're then potentially going to get another 8. And you then, I'm looking at the green numbers here, and you're going to get 11. So that is 16, 27. That is 33. However, there is variable consideration. And so a judgment needs to be made. Now, what is that judgment? That judgment is that the final payment will be reduced by 1 million for each full delay. Now, I don't know whether you read this. I don't know whether you picked it up, but you should be looking for it. And we expect the contract here to be completed on the 15th of August. And actually, it should have been transferred on the 30th of June. And there's a 1 million delay for every full month, so it's the full month of July is applicable, yeah. So a judgment needs to be made. It is estimated that 1 month delay is applicable, so the you know, our best estimate is not 33 but is $32 million for the contract, and we are 30% complete. And if we are 30% complete, 10% would be 3.2. So therefore, effectively, the revenue that we are recognizing here is going to be 9.6 million. Yeah, is the revenue for the reporting period for the year end for the activity in the 30th of June X3. Now, I'm going for low-hanging fruit. I'm answering the question directly. I'm going head on. I don't think I'm anywhere near 12 out of 12, but I've made a cracking start, and I'm slightly scrambling around for additional things to say. But not only do I have to work out, not only have to explain the revenue, I've got to explain generally how the contract is accounted for and show the amounts to be included in the financial statements. So the revenue is but one figure, yeah. Costs will also, yeah, be recognized, yeah, to match. And this is over the 6 months, because the contract didn't start until the 1st of Jan, yeah, and we're looking at a year end of 30th of June. Now, I think I have got more than one type of cost. Now, you could do this in the spreadsheet. You could, of course, you could. But let me just try and keep it as simple as possible. What costs have we got? We have got the cost of the plant. Yeah, we got the cost of the plant, and the cost of the plant was a total of 16 million. But not all of that is going to be, because actually we will only want the depreciation. What other costs do we have here? We've got direct costs, labour costs. So those costs are going to be per month, and we've got 1.2 million per month, and we know there are 6 months, so that is 7, that is 6, that is 7.2 million. That is 7.2 million, I would say. And then the other cost we've got is the one-off cost. Now, we're not going to spread this over the contract period. We're going to take it in the hit. Yeah, we're going to take the hit in the accounting period. So we've got our one-off cost. And how much is our one-off cost? Our one-off cost is, 2. Our rectification cost there is 2. Now, how do we come to the depreciation? We had it for 6 months. But if you think of the useful life of the plant is 5 years, if you think of the useful life of the plant being 5 years, 5 years, if you think about it in months, is 60 months. So we have got here, 6 divided by 60 in terms of months. So it's that fraction is your depreciation. So that is effectively 1/10. So that is effectively 1.6 million in terms of costs. So therefore, your total P&L costs, for this contract is 1 plus 7 plus 2, which is 10, and therefore the total there is 10.8 million. 10.8 million would be your total contract cost, and that final column there effectively can be deleted if you wanted it to, but I'm not going to worry too much about that. Let me make friends with the marker by just putting that in bold, because that is a figure, so therefore presumably that figure will be worth a separate mark in its own right. What else? What else? What else is relatively straightforward? What else is relatively simple to be picking up on this question in terms of numbers? Well, maybe when you think about the balance sheet, there would also be in the balance sheet that non-current asset of PPE, because if you bought it for 16 million and you have depreciated it by effectively 1.6 million, then you've got a carrying value, or you've got a net book value of the difference. And that difference is 14.4 million. I mean, you can use a calculator if you need to, you can use a spreadsheet if you need to, but actually, let's take a fairly common sense approach. The only other thing I can think of in terms of easy stuff, in terms of straightforward stuff, is to think about the contract balance that you will have left. Because you have received cash already. You've received cash of the 6 million. You got the non-refundable deposit of 6 million. You got that non-refundable deposit of 6 million. And because we were 30% complete, we got the 8 million as well. So we have received effectively 14 million. We've received effectively 14 million in cash. But we haven't recognized that amount of revenue. So we've debited cash and we've credited the contract account. Of that contract, the amount of revenue that we have recognized to date, and this is where the own figure rule would apply, because I'm going to use the figure that I've got in the question that I've calculated. And if you use the figure that you've calculated, but you calculated it incorrectly, you will still get credit for this. So you take away the revenue that has been recognized because you've debited that account to credit the revenue. This then gives you a difference of 4.4 million. This then gives you a difference of 4.4 million. And you've got to say to yourself, is that difference an asset? Or is that difference a liability? Is that difference effectively what we're owed? Or have we got an element here of deferred income and liability. And because the cash we've received is more than the revenue, this is a current liability. So let me just take that out of bold. Let me just take that little bit there out of bold so that the marker can their eye is immediately drawn to the numbers that we want them to be drawn to. Yeah, the four numbers that we've come up with: the revenue, the costs, the PPE, and the contract balance. Yes, the model answer is longer. Yes, the model answer is a little bit more polished, but you are effectively watching me sweat. Produce an answer, a good answer, a structured answer, the sort of answer that if you want to pass this exam, you need to be able to produce within the time allowed. Okay? Not perfect. I'm not claiming 12 out of 12. I'm claiming, though, that this answer is going to give me 8, 9. Yeah? This is good enough. There's nothing in this answer which is technically incorrect. And I move. And I move to Exhibit 2. Because looking at Exhibit 2 gives me the ingredients. Looking at Exhibit 2 gives me the awareness to be able to answer the second, to enable me to answer Part B of the question. And Part B of the question is 6 marks. 6 marks. Okay? Using Exhibit 2, calculate and explain the gain arising to the Weller Group on the disposal of the overseas subsidiary that will be recognised in the group profit and loss account. So that lovely word "and." We've got two things to do. We have got to calculate. Yeah, we have got two things to do. We have got to calculate and we have got to explain what is going on. And you can calculate in a spreadsheet or you can calculate in a simple table. The numbers that we're looking at here are very straightforward. This is the disposal of an overseas subsidiary. We've sold 100% of the equity, so there is no suggestion of any non-controlling interest. There's no suggestion of any residual holding. The proceeds are 500. Thank you very much indeed. The proceeds are 500. I'm going straight into a simple calculation. We have the proceeds. How much are the proceeds? The proceeds are 500. Debit cash, credit, disposals account. What are we getting rid of? We're not getting rid of the investment. Don't even know the investment. The investment is the individual company. In the group accounts, the subsidiary is consolidated using acquisition accounting. So we are deducting the net assets at the date of the disposal, and the net assets at the date of disposal are 200. So that is what we are de-recognizing. We're also de-recognizing. We're also closing down. So we're also crediting the asset and debiting over here the goodwill. And the goodwill that's left standing is 100,000, and we're getting rid of that. Now there's no NCI and there's no residual, but we do have an overseas subsidiary and there is an exchange gain that has accumulated in equity. Now that exchange gain will be a credit balance. We're going to recycle that. We're going to bring that into the calculation. So that is 50,000 that comes in. Had it been an exchange loss, it would be a minus, but it's an exchange gain. So this is then the gain to the profit and loss account that we will report. So mental maths, bish bash bosh, that is 250,000. So this is 6 marks. So there's probably 2 or maybe 3 marks available for sorting out that. There's probably 2 marks or 3 marks available for sorting out that calculation. And however many marks are, I've got them. But I now need to briefly explain what is going on. And I'm just going to write down effectively what I was saying. Now I'm relatively happy here. Yeah, I'm relatively happy here that I've numerically worked out the correct profit or loss on the disposal. And I've said, we're losing control of a sub. So acquisition accounting ceases, proceeds come in, the profit is in the P&L. And we are then, because we've no longer got a sub and we're no longer acquisition accounting, we are de-recognizing the net assets and the goodwill of the sub. Yeah? And this business about the exchange difference that's in equity, if it was PPE, if it was a revaluation gain on PPE, you wouldn't recycle. I say 16 doesn't allow it. But I say 21 mandates that you do recycle the cumulative balance that's sitting in equity, so you look to close it off. I'm just going to show you something here which is a little bit naughty and certainly is not part of any answer I would recommend. The first entry in that disposals account is a credit balance because we've received the proceeds of 500 and we are debiting cash and crediting disposals. So the net assets are a debit because effectively what we're doing is we're closing off the net assets. We're removing the net assets of 200,000 from the balance sheet, and therefore we're debiting in the disposals account. Yeah, we're debiting in the disposals account the 200, which is why it shows as a minus number, because we've established in the beginning the disposals account is a credit orientated account. So when the positive number's at the end of 250, that 250 being a positive number is a profit. And you can see that we've got the same entry, or the same principle as before with the goodwill. You're debiting the disposals account by 100,000, and you are crediting the goodwill. Goodwill is an asset. Assets are debit balances, so you're crediting the goodwill. I'm showing this to you to understand. I'm showing to this to kind of reinforce not a love of journals, but an awareness of journals. You do not need to do journals to answer this question. You do not need to do journals to answer this question, but I just thought it would help. And what we're doing is, if you've got an exchange gain in equity, that exchange gain is a credit balance. So you're debiting equity to close off the account. Because if you've no longer got the foreign sub, you no longer want to have in the accounts the exchange difference. So we're debiting other components of equity, or we're debiting a foreign exchange reserve. I don't really care what you call it, but we're closing that account down to nil, and we are effectively transferring it to the disposals account, to the P&L account, if you like, with the 50,000. And what you're left with is the balancing figure on the account, as you can see, of 250. The last 3 or 4 minutes have been a bit of teaching. The last 3 or 4 minutes have been a bit of a Brucey bonus. A bit of an extra. Don't do this in the exam. Only do journals if you are very explicitly asked to do journals, and then do a little bit of narrative that goes with it as well. All right, I am moving on. You can replay that if you want to replay it. If you think I was talking too fast, of course, just go back and replay it. Just go back and replay it. And I'm moving on. Remember, journals were not needed. They were not asked for. And I'm moving on to the third and final part of this particular question, which deals with deferred tax. So these are totally separate, standalone, independent aspects with independent exhibits. And we have losses, we have a deferred tax asset. So we normally think of deferred tax liabilities, we normally think of accounting gains, we normally think of taxable temporary differences, we normally think of deferred tax as a liability. But we're discussing whether there should be a deferred tax asset in the accounts, and we've got no real numbers to go on. There is a percentage, but it's not a tax percentage. So this is purely a discussion process that we're looking to do. There are losses for the 1, 2, 3 years. And actually this year, although we've made a small profit, it's because of one-off items. So what we've got is a track record of 4 years of losses. 4 years of losses. Now, this has created a material deferred tax asset, but this asset will expire, will not be capable of being recovered beyond X5. So it's only got a couple of years. Now, Weller recognizes this asset because high growth and profitability is forecast. This asset can only be recovered if Weller makes a profit in the future. Year 1, loss. Year 2, loss. Year 3, loss. Year 4, loss. Last 4 years, basically we've made trading losses. But if the golden days are about to happen, then we can recover the deferred tax asset against those brought forward losses, those carried forward losses. Why does Weller think this? Because indications from customers, planned expansion, blah-de-blah-de-blah-de-blah-de-blah. There are no short-term tax planning opportunities. Okay, so there's no ability to generate some kind of artificial loss. Right, I think to begin with, we need to kind of set the scene and demonstrate a little bit of, basic technical knowledge that losses carried forward, do create So I'm just beginning with a bit of theory, beginning with a bit of knowledge that losses do create deductible temporary differences. The loss is recognised in the P&L. You get no current tax relief, so it's got a nil tax base in effect, and you've accelerated the payment of tax. You do create you do recognise a deferred tax asset in order to debit the asset to credit the P&L with a tax, so that the loss that you're reporting is post-tax. So the fundamental reason why we account for deferred tax is the matching concept. But you're dealing here with an asset. But is it an asset? But are these is this deferred tax asset going to be recovered? Is it more likely or not there will be future profits, future taxable profits, for us to be able to offset this? And, it's a judgment. And what are we actually considering in this situation? What we've got is a track record of losses. We've got a track record of losses. We've got a limited time frame. It's got to happen. We've got a limited time frame. It's got to happen in the next couple of years. We've got no tax planning opportunities, and we've got optimism. We've got hope. But I don't actually think hope is enough. There are no tangible signs of improvement, only hope. There's no tangible signs of future profits, only hope. And that is not enough, in my opinion, and that's not enough. So they've done the wrong thing. Weller's done the wrong thing, and that is not enough. No asset should be carried forward. No deferred asset should be recognised. It should be written off. And that's bad news. It's not good. But we've got to be prudent. We've got to be faithful. We've got to comply with the accounting standard. You've got to comply with ISA 12. So no deferred tax asset should be recognised. It should be written off. And this is a this is a question, and that's my answer. Yes, if you look at the model answer, it goes on a little bit more, but that's fine. Your objective is to pass. Your objective is to get 50%. Your objective is to attempt every part of every question, to pick the low-hanging fruit. Your objective is not to get a perfect answer, not to get 100%. All right? The model answers you're looking at, they're worth 100%. I'm here under time pressure. I'm showing you what a really good student could do, what a prize-winning student should do. So I'm a little bit manic. Don't care about the spelling. I care about the presentation. I care about technically writing things which are correct. And if I make a mistake, I can go back, I can edit. Yeah? I hope you get where I'm coming from. Onwards and upwards.